Well, according to my Apple devices in front of me, it is 6 o'clock Eastern, 3 o'clock Pacific. And we like to be prompt because for many of you, it is past the hour of wanting to force yourself to be on a Zoom call or a Teams call any longer than possible. So we are very, very glad that you're joining us. For those of you who don't know me, my name is Jeff Breese. I hope you all do. One of the partners here at the Wealth Stewards. We've got a whole swath of the team here on camera and the rest of the team in attendance with you all today. So we're really excited to be here for our mid-year town hall meeting. I was thinking about it. We've been doing town halls now for a year. I think last July was the first one. And we've certainly, I think, evolved it. We're excited for today's content with multiple speakers and lots of different topics. So I want to go through real quick the agenda with everybody, and then we'll pass it along to all of our speakers. So Chris, if you could advance to the next slide, that'd be fantastic. Great. So our agenda today, obviously I'm opening. Just want to cover what we're going to go through today and then turn it over to our other speakers. So our opening remarks, sort of already made them. We're very grateful for you to take time out of your busy schedules to listen to what we hope is the most concise and robust quarterly update that we give as a firm. Any of you, as you know, are more than welcome to call us individually or collect us all in the room if you want to hear any opinions on the off cycle outside of these calls. So we're happy to be accessible in whatever way you need. We're going to talk next after my remarks here about the last quarter. Brent's going to cover that and go through some slides about what's going on and in particular the wild ride that was Q2 of 2025. So I won't steal Brent's thunder from that, but I'll let him cover all of that. And then what happened right at the beginning of the quarter on the back end of June 30th going into the July 4th holiday, which is the new One Big Beautiful Bill. So the OBBB, I don't know, we'll come up with some really good name for it eventually. Excuse me. And then we're going to talk about trusted contacts, a topic that many of you have been poked and prodded on at least once before, most likely. Denise is going to go over the importance of a trusted contact as it relates to your relationship with us. I'll go through a major project going on behind the scenes, which is a complete rebuild from the ground up of our website. Show you a little preview of a little bit of that and talk about some of the functionality of it. And then, of course, as always, we're going to end with our Q&A. It is our hope to get you out of here in 30 to 45 minutes, depending on Q&A, so that if you've got to get somewhere at the top of the hour, if you just want to leave, you are more than able to before the top of the hour. So with that, I'd love to turn it over to Brent. Brent, go ahead and give us the recap of Q2.
A lot to recap here for sure. And Chris, you can go ahead to the next slide. So we had three major themes coming into this year from an investment standpoint. And the first was that we thought the markets were fragile. We thought the valuations, particularly for U.S. large cap stocks, were definitely extended. Position concentration within the major indexes, meaning a very small group of companies really driving performance of the larger indexes, has become historically unlike anything we've ever seen. And we thought both of those things, along with the potential for some inflation down the road, had the potential to sow some volatility this year. Now, we weren't expecting some of our thinking to be stress tested as quickly as it was in early April. We're going to touch on that and how everything sort of worked out in that environment. But our second theme was durability. So we think you really need to be intentional about where you're placing your money today. And we do think the durability or the resilience of portfolios, it is available out there if you're willing to look for it. And it's available at a relatively modest cost. And I think we've incorporated a lot of that into our existing portfolios. And this third major theme of this year was the age of alpha. And that just means that if you get active management in any of these asset classes, you're going to pay for it. But if you're going to pay for it, it has to be in areas where you think you're actually getting significant value that's added. So we're kind of in this mode where we believe that certain areas of the markets you should be passively invested and be in those markets for the long haul. But there are other areas where it pays to have active management. And that's on the equity side, it's in the fixed income side. And it's also in the alternative investment side and the private market side, which is becoming an increasingly large part of our portfolios. And we think that this age of alpha, these alternatives, this active management really enhances portfolio resilience. And again, this year, I think we had it stress tested in the second quarter. It was interesting to see how everything played out. So Chris, you can go to the next slide. So, guiding principles behind these changes or behind these themes is first, we really want to diversify these portfolios with very key intent, not just throwing darts at a board, because we're coming out of a really unique time in the markets where pretty much since the financial crisis. If you landed on the S&P 500 for pretty much anything, you did fairly well. And a lot of other asset classes were ignored, and we thought that there was some real value there. You saw again this quarter, the time in the markets is absolutely your ally. If you look at all the volatility that you see, not just this year, but throughout history in the markets, you stretch out that time frame long enough, and that volatility really flattens. What you see is a much smoother line, and you don't get these massive swings like you saw in Q2. So time is your ally. Next point is price matters. That's why we made a big push into some other asset classes, which we're going to talk about, where we thought the valuations were far more attractive. And I think you're seeing the fruits of that now. And you continue to be, as long as I've been in this business now, going back to 1996, you're compensated for remaining calm when things look a little bit rocky, because it's going to happen. We saw it. It was a blip on the radar in terms of in April, but we did see a pretty wild ride. So let's go ahead to the next slide, Chris. So if you went to bed on March 31st and looked at where the S&P 500 was, you would have seen a return on the year of maybe flat for the year, about up or down a fraction of percentage point. If you logged in again and you looked on June the 30th where the S&P was, at that point you saw the S&P maybe up about 5.5%. What you missed was this massive volatility that occurred within the quarter thanks to Liberation Day. So if you recall, the beginning of April, Trump came out with Liberation Day, where he talked about this idea of reciprocal tariffs with pretty much every single trading partner that the United States has. Now, I'm not going to say what's a good idea, bad idea, or what it is, but I will say that it created a lot of uncertainty in the markets, because even clients that we've spoken with directly, imagine you are a business owner and you're importing 40% of your cost of goods is coming in from overseas, and you're trying to budget between, am I paying a 40% tariff, a 10% tariff, a 90% tariff? People just didn't know. And so you saw in a very short period of time, before kind of the smoke cleared a little bit, there were extensions put on all this stuff, but you saw a really significant dip that occurred in the markets when this was announced. Next slide, please, Chris. And you see it illustrated here. So this is looking back to the beginning of the year. The two lines you're looking at is this, the dark blue line on the very top. This is the MSCI fee. Now, when you look at that, I just want you to think of developed international markets. So think Europe, Japan primarily, Korea is in there as well. But these are developed, very highly developed markets outside of the United States. The black line underneath is the S&P 500. So think the 500 largest companies here in the United States that are listed. And what you saw is the S&P was kind of getting weak coming into the beginning of April. But when these tariffs and Liberation Day came out, you saw a real dramatic decrease in the value of equities. And it happened in a really short time. As you're going to see here, you saw the S&P 500 at one point was down about 15%. The NASDAQ was hit even harder. The NASDAQ down essentially in a straight line in about a week or so, down about 20%. Now, international stocks, which is another key theme for us, they hung in there. They barely went negative. But this was a really, really dramatic ride. And I think that when this was announced, very few people would have imagined that you would have seen not only a recovery, but you would have seen positive markets by the end of the quarter. So let's go ahead to the next slide. So we're kind of at this point where we hit Liberation Day and things got a little bit crazy, but we ended the quarter on a real positive note, at least in terms of equity performance. And now you're kind of in limbo, because we still have some of these issues that are out there. A lot of the trading deals some have been finalized, many have not. You're also seeing that kind of post-shock, the economy is kind of idling in neutral. If you look at some of the positive aspects that are out there, negative aspects, they're kind of balancing out. So where the economy goes from here, it's kind of tough to say. You do have some pretty good tailwinds. So the one big beautiful bill, which Ryan and Cyrus are going to dive into a little bit more, if anything, whether you like what's in it or not, it does create, particularly around taxes, a degree of certainty, which generally the markets like some certainty. And it does add some manufacturing incentives and consumer reliefs. But you still have a lot of headwinds out there. The Fed has indicated at least they're going to stay restrictive. It doesn't look like inflation has been completely killed yet, although it's a little bit under control. And you do have consumers getting a little bit worn out, paying a lot more money to finance different purchases. So I think in this kind of background, you have to continue to stay nimble here and continue to look for places where we feel is the best opportunity. Let's go ahead to the next one. So through all this, how did our target portfolios perform? And again, it was a really great stress test for us in terms of what our thinking was as we worked as a team to build out these portfolios. And I'm looking at this column here. It says year-to-date low. S&P 500 at one point last quarter was down 14.98%. Let's call it 15%. The NASDAQ was down about 21%. Most of our clients are living here kind of between taxable conservative to say taxable balance of growth. Most of you saw declines down about 2 to call it 7% if you're for more aggressive clients. But that was a far cry from down 15% in the S&P 500 or down 20%. And most people are significantly positive so far this year. And we look at this idea too of what some of the vulnerabilities are in the market is still this. But we've had this big rebound in U.S. stocks. U.S. stocks are expensive relative to bonds, also relative to international markets. So right now we think there's definitely some opportunity in fixed income, which we've allocated towards, and we think there continues to be opportunities in international markets, just based on the fact that we're at a historical valuation gap between U.S. assets and international assets. And last slide here, Chris. And to this point, the biggest change that we made in my now 17 years being on this side of the business, it was the single largest portfolio reallocation, at least that I had done for my clients. And we did this January into February. I would say the biggest change in our portfolios was taking a significant amount out of US equities and earmarking those to alternative asset classes, but also kind of more importantly, international stocks. This year, again, the stress test came early, but so far so good because you have seen the biggest outperformance so far year to date of international developed markets relative to the S&P 500, relative to US markets, than we've seen in 20 years. International stocks are outperforming US stocks by 13.2%. So again, early stress test to our thinking, but overall for the quarter, it was exciting to watch. It was a little bit nerve-wracking at times, but I do think that the different themes that we had in place for 2025, they continue to play out. And now I'll turn it over to Cyrus and Ryan, and you guys are going to tell us what is in this one big, beautiful bill.
Hey guys, before you jump in there, can I just make one quick comment I forgot to make a minute ago? There is a Q&A feature if while we're speaking through these topics, something comes to mind and you want to type it in. I'm monitoring those. We won't answer them until the Q&A section, but if you don't want to lose your question or forget or not know, what part of the presentation you had a question on, you can just enter it in now and we'll get to it later on. Sorry.
Perfect. Thanks, Jeff. All right, so without further ado, if you've watched the news at all, you've heard a lot about this bill that's passed. And so if you're like me, you've seen a lot of bills come through over the years, but I guarantee you've never seen one bigger than this one, more beautiful than this bill. So much so you may have thought this was two bills, but this was not two bills. This was just one big, beautiful bill that we had that came across. So this is a roughly 900-page document. Obviously, we can't summarize that entire thing in this presentation because you have a life. So we're going to just summarize some of the key points here, specifically to individuals. And there's a lot that happened with business owners and other areas that we can discuss at another time, but wanted to cover some of these key principles. And I'm going to let Cyrus kind of take it from here and go over some of those.
Thank you, Ryan. And so you can see a few of them here. Now, before I get into what has happened and some of the changes through the big, beautiful bill, I just wanted to take a step back. During President Trump's first term in office, the Tax Cuts and Jobs Act was signed into law and effective in 2018. Among other things, this lowered individual and corporate tax rates, doubled estate tax exemptions, and made some other meaningful changes with standard deductions and other things. This bill was set to sunset at the end of 2025, where things were going to revert back to how they were prior to 2018. Tax rates, estate tax exemptions, and much more. That said, you'll see here in that first column that tax rates have been permanently extended. So, permanent doesn't mean forever. It does mean, however, that the government will actually have to pass other legislation to change these, and there's no end date. You'll also see here that standard deductions have been permanently extended. Other newer deductions have also been added. One is this enhanced senior deduction with an additional deduction of up to $6,000 on top of normal standard deductions for anybody 65 or older. You may have heard of Social Security deductions. And while there wasn't really a direct law to change how Social Security is taxed, this added deduction is meant to indirectly offset the taxes of Social Security. The other deduction that you see here is for tips and overtime deduction. Now, both of these have a phase out where if you make over a certain dollar amount, those will reduce over time. I think many people joining today are probably not earning tips or have overtime, but you probably know someone who is. And so this is going to help that demographic be able to keep a little bit more in terms of what they're making via tips or overtime. I'm going to let Ryan go over a little bit of the additional deductions that are listed there as well.
Perfect. Thanks, Cyrus. Yeah, so additional deductions. Many of you recall prior to those changes, SALT had an unlimited cap. So there was no cap on this, but when those rolled out, they moved that cap to 10,000. So that had a pretty big impact on a lot of individuals. So there is a temporary reprieve from that 2026 through 2029. That's going to be increased to 40,000. There is a phase down that starts at 500,000 of income. So if you're above that, it's going to reduce, but you still have the floor at the 10,000. After 2029, that's going to revert back to the 10,000. And then AMT tax. So this, again, when they rolled out in President Trump's initial, with the Tax Cuts and Jobs Act, the AMT increased to an extent that this pretty much doesn't impact 99% of individuals. The only change here, they made that permanent, so that's not going away permanent until the next time they change the laws. And then home mortgage interest, again, this is already in place, so this isn't a new concept, it's just making that permanent. And one new item that we do have here is charitable deductions. So if you're not itemizing, you're able to do a 2,000 if you're married filing joint, or 1,000 for single, where that is deductible. A couple other important changes here, Cyrus, if you want to go over those.
Sure. And I mentioned earlier about how the Tax Cuts and Jobs Act not only changed income taxes, but the estate planning and estate taxes as well. At the end of this year, estate exemptions were set to get cut back in half, roughly 7.5 million per individual, or 15 million per couple married filing jointly. Any dollar above that would be taxed at 40%. Instead, this has been permanently extended, where you see 15 million per person, 30 million for a married filing jointly couple, adjusted for inflation going forward. So a lot of people were wondering what was going to happen and if they needed to look into more complex estate planning, and this at least helps kick the can down the road a little bit longer. Another unique addition was this Trump account. Accounts are now available for beneficiaries under the age of 18, and it's basically like a normal IRA with a retirement age of 59 and a half, but under certain circumstances, these are distributable at age 18 as well, under certain things like first-time home buyer or tuition. There's certain rules around this as well, but this was actually something initially proposed years ago by Warren Buffett. And you'll see here there's this new pilot program between 2025 and 2028, where any newborn is going to get $1,000 contribution made into that Trump account. This money, kind of like a state-sponsored or government-sponsored account, like many college savings accounts, it must be invested in a qualified mutual fund, essentially one that's going to track an index like the S&P or something else. But the thought here, and Buffett put some of it to math, if the S&P provides returns like it has historically, $1,000 when someone is born could be $250,000 when they reach the age of 65. Now, past returns are not indicative of future returns, but it's just another added way of looking at a universal savings account and more opportunities to save. And so, as Ryan mentioned, it's a long bill, but these are just some of the bullet points that we wanted to go over with you today.
Perfect. We'll kick it over to Denise. Go ahead and take over.
Hi, everyone. For those of you who haven't met, my name is Denise McGuire, and I just want to spend just a couple minutes talking to you today about trusted contacts. I think this picture here is, the slide, but that was someone thinking about whether they should name a trusted contact, and hopefully I'll convince you that you should. So next slide. First off, who is a trusted contact? So this is simply someone that you authorize us to call if we ever have some concerns. So what might those concerns be? We may have trouble reaching you. We might notice some unusual activity in your account. We might suspect there's some fraud or financial exploitation. or we do start to notice some signs of diminished capacity. For example, we may be trying to call you and email you. Maybe your statements start getting returned to Fidelity. So then we would reach out to your trusted contact to try to find out, if you're okay, if something has happened, and then we can help you. So who would make a good trusted contact? This would be a family member or a close friend. We just ask that you keep in mind it should be someone that knows you well enough to know what's going on with you so that they can help us. Also important to note, a trusted contact has no authority to make any decisions regarding your account, and they certainly don't have access to your accounts. I like to think of them like on your phone, you have that person that's your ICE person. In case of emergency, they can't get in your phone and do anything, but it's someone that can speed up us helping you if something, is going wrong. So we do definitely recommend that you appoint one. And like all of you are definitely know, anything that we do here requires a form and it requires you to sign it. So if you would like to name a trusted contact, just give us a call or maybe email your advisor and let us know who you want that to be. And we'll get the form signed and get it out to you. So that's it for that. If you want to move the slide forward, and we'll go back to Jeff.
Thanks, Denise. The trusted contact topic is one that sort of came in our world 3 or 4 years ago. And I will tell you that it's one of those things, it's kind of like long-term care. And what I mean by that is what we find a lot of times is that people don't really care about long-term care until they actually are like right in the situation and need long-term care. And usually the acute need for it is not the time that you should be talking about those things. So trusted contacts are a little bit like that. It's something that might seem unimportant today, but the future you and the future us who look to serve you, it could be monumentally important just in safeguarding your account and your financial well-being. So it's an important thing. So thank you, Denise. I get the joy of talking about something that we've been working on in the background for what now has been probably 5 months, I would guess. So effective September 30th, we're going to launch a brand new website, which all of you may or may not be excited about. We are. It's going to speak a different language. It's going to have 100% custom build, our feel, our site, and it will embody everything that the updated version of the Wealth Stewards and all the great people that you're hearing from that serve you are about. So I just want to give you a couple of slides to talk about and to show you some visuals and maybe garner a little bit of interest that when that email does come out at the end of this quarter, that it is live and it is available, you'll at least go there. Know that much like all of our existing and prior websites, you'll go there to be able to look at profiles of the team. You'll be able to go there to look at, to get into your accounts with Fidelity, or if Schwab is your custodian, well, links for you to be able to do all that. So all the functionality that's needed as an existing client will be there, but there's going to be a lot more, and we're excited to share that with you. So just a quick screenshot. This is going to be the very beginning of what you see on the homepage. It'll be a scrolling homepage and scrolling pages, which I hope most of you are used to by now, as opposed to just screenshot after screenshot for websites. So we've come up after a lot of work and a lot of marketing time and hours spent. We love this tagline moving forward, that we intend and hope for all that we serve and those in the future we intend to serve, that we are engaged advisors who are giving you evolved portfolios. And as most of you know, as clients, one of the biggest pickups to the jump from Raymond James and other firms that some of us have come from was to be able to offer evolved portfolios to do things like what Brent talked about. So we want to really go out there with that messaging. And so we love this. Chris, next slide, please. We're going to have additional verbiage on the website. Again, these are things that we really want to start driving into, and this idea of, managing your portfolios. Most of you at some point in your investing career did not have us. And what we think and what we hear a lot in feedback from clients is there was a point where you all were ready to stop managing on your own, or worrying about it on your own for a lot of you. And that next level after managing, we believe, and what we're really good at is helping with mastery and scaling the rest of the types of things necessary to make you go to the next level, and most importantly, to keep you there. So another visual on kind of the backdrop of the website and some of the verbiage we'll use. And then the third one, if you can hit that, Chris, we're really going to drive into speaking the language of the types of people we serve. And many of you don't know this, but there are specific profiles, financial profiles that you all embody that are our preferred types of clientele. These are things that we monitor on the back end. And when we engaged you all at some point in the past, we were looking for these things. And fortunately, you had them. That's why many of you are clients of ours. And so we're really driving into the idea that for new business and new opportunities and new people we meet, we really want these people to be inside of these four core groupings. One is a continuation of our offering to entrepreneurs and business owners. That's one of the large reasons why we have all come together. We believe that there is a large amount of work to be done for a lot of business owners, but certainly by the entire book of business that all of us run, you're not all business owners. But the rest of you usually fall within one of the next two categories, in addition to maybe being a business owner or an entrepreneur. And then as many of you people are what we call financial independents. And financial independents are people who are, your personality isn't intrinsically and on a daily basis tied directly to your wealth. You love wealth, you love money, and it's great that you have it. But the way you live your lives is independent of that. You're passionate about other things. And people who are financially independent really want to focus on those things, which makes us a great outlet for the money part of it. So many of you fit that profile, and we love working with you. The third one is the most popular of the database of clients that we serve, and that is the family steward. And very simply, family stewards are people with money, and that money has nothing to do with your own needs and wants and desires. You view your money as a driver to help support the people and the things that you love. So, by the way, some of you are combinations of these things. And so we love our family stewards. We love all of our clients, but we love our family stewards because they speak to others, and that focus is tremendously motivating to us. And then the last one, and this is going to be a big pickup inside of the new website, excuse me, I'm coming off a summer cold, is what we've dubbed Elite Wealth Services. So there are a select group of families in our client base and out there in the world today that achieve a level of wealth that has a level of sophistication with problems all unto their own. And they're different kinds of problems. It's not problems like, can I retire? Can my kids go to college? It's like, oh gosh, this one beautiful bill, I'm going to have a problem that I'm going to have to pay money to the IRS, or I'm going to have estate taxes, or I can't figure out how to teach my kids about the type of money they're going to inherit, or there are select services that I need, whether it's coordinating my tax in my business entities. So these are examples of an elite wealth service offering that's been emerging throughout each of our business units, that when we came together, we realized we wanted to put together a select offering for. And so the fourth element of this website and who we'll be speaking to inside the current client base and then outside of it is this elite wealth services. So that's it for the website preview. Just wanted to give you all kind of a look and feel, especially a heads up that this reboot is coming. We'll communicate plenty of time in advance. This will have no impact on your access to our custom client portal, Black Diamond, that you're used to seeing on a regular basis if you log in, or if you're logging into Fidelity or Schwab, because that's where you go primarily. That won't change. This is literally a rebrand of the TWS.finance website. That is the firm website. So we're excited. We hope you, if you're not today, maybe are a little bit more interested, and certainly by the end of September are very interested and excited about what we are able to show and do for you and communicate through this website. So that's it for website. Let's move forward, Chris, to Q&A. So we're at 29 minutes. And yeah, everybody come back online because, it's like a hot potato on the Q&A. So everybody can come back. Denise, you too. especially if there's a trusted contact question. I've got 2 questions that came up. One I already answered, but I'll say it out loud because other people might have this question. So the first question that's come across so far, which is, given U.S. equity valuations, are we considering reducing exposure further to U.S. equities in favor of, the question is in particular bonds, but I would extend it, are there other categories? So right now, are we as an entity, as a team, looking at making further reductions to U.S. equities? Anybody wants to jump in and go ahead and answer that?
I'll hop in on that one. I think that right now, on relative to many of our peers, and I'd say particularly, there's something called a home market bias, which is every investor has a certain degree of bias toward their home market, and there's a ton of reasons for that. But we have already made such a big reallocation in the private markets, alternative asset classes, and also international, that we're at this point, and that's not to say that can't change next quarter or at some point next year in the future, or perhaps U.S. equities get to a point from a valuation standpoint where they're more attractive again. But at this point, the changes that we made, we're going to let these play out for the foreseeable future.
Great. Anybody else? Cyrus, Ryan, anything to throw in there?
I got
Not to
nothing.
put you on the spot. All right. Oh, I've got another one that came in. Great. So another question that came in, which I haven't answered, so anybody can take their shot at it. Has the new budget bill changed any of our recommendations for when to initiate Social Security?
Yeah, I can take that one. So this big, beautiful bill that we got, it actually does not address anything. There's no changes in this bill specifically to Social Security. So the things that you looked at in the past, you're going to continue looking at to determine when to turn on Social Security. So, you're going to continue modeling longevity expectations, break-even analysis, the things that we've always gone over, cash flow related, tax related planning, but nothing new from this bill.
Yeah, and I'd throw in one thing, depending on who you listen to, there are reports that this bill is going to add $4 trillion to the national debt trajectory. And then sort of on the other side, you've got, no, it's going to stimulate the type of growth, so that won't happen. I think I would lean towards the idea that, much like over the last couple of years since the 2017 bill was passed, you see the debt load of the U.S. increase. And so I think the factor that perhaps might come into play in discussions, can't really model it because it's a future thing, is if you're uncomfortable with a continued increase in debt trajectory for the United States and the ability of the United States to pay your Social Security in the manner that you indicated, perhaps that's a variable that, should be discussed with your advisor as well.
Great point.
Okay. Yeah, Brent, go ahead. Did you have something? Oh, no, he's on mute. That was next question. Regarding the new website, is it better go to the TWS website first and then Fidelity or Schwab? The best way to navigate into what we need to know about the Wealth Stewards and our portfolio as shown by the financial firms. Thank you. Who wants to handle it? I mean, I can answer it, but I'm going to shut up and let somebody else do it. D, you're not on mute.
No, I'm not on mute. All right. Well, the next question's for me, but I guess I can answer this one too. I would say it's our preference that you go to the website first and you log into our unique online portal that we created just for you. All of your information from either Fidelity or Schwab flows into that site, and it's just a lot more robust and has a lot of great information for you there. So you're certainly, the link to Fidelity is in our portal. So if you like that, you can certainly go there. But our recommendation, what we'd like you to do is go to the website and go into our site that we created for you.
Good, Brent.
I'll add something to that because that's kind of a two-part question in the sense that those of you that are clients, you've been dealing essentially with two different kind of interfaces. Is one, Fidelity, Schwab, in some cases Goldman Sachs, whoever the custodian is. But then we also have our portal in which we can aggregate a lot of that information into one single place. And there's also a really safe, file sharing environment and everything else there. So from an informational perspective about what's actually happening in your accounts, our portal is something different than the website. So where the website that Jeff is discussing that's going to get launched the end of September will be different, is there's going to be a lot of our thinking and a lot of our content is on there. As some of you know, I've got a podcast. Jeff is going to be launching a podcast probably at some point next month. We've got white papers, we've got blogs, we've got videos, we've got recordings of like everything we're discussing today. So the value, I think, to our existing clients, of course, it's going to be a billboard and it's going to be an offering to people that might not be working with us today. But to existing clients, it's going to be a point of reference for a lot of the thought leadership stuff that we're putting out.
Yeah, I mean, our expectation is that once we put the website up, you'll never call us again. No, I'm just kidding. I'm just totally kidding. But there'll be the content there that if you have more significant questions than just looking at the website and it's late at night or it's the weekend, again, you can dive in as much as you want. The other thing I'll say about our custom client portal, or two quick things. One, your custodian statements monthly are in there. So there's a place where your statements are automatically uploaded. So if you're on Fidelity, those Fidelity statements are inside there. And the other one is that some of your assets are not at Fidelity or Schwab. So for those of you who have college savings plans, annuities, insurance products, many of those things don't exist at Fidelity or Schwab. So if you're somebody who has those, you're going to be missing out on information direct at the custodian at Fidelity or Schwab. And our portal brings almost always, there are exceptions to everything, almost always brings those all in for a wider view for you. All right, next question. Denise, this one's a layup for you. We call this a softball, and I love it because it's actually a great question. So how do I actually add a trusted contact? Do I ask for a form via email? Do I call you? Who do I call? What do I do?
So what I would say to that is whatever is easiest for you. You can call us at our number, or if you have one of our emails already, queued up in your email, shoot us an email. We just need to know who the person is and their contact information, and then we will fill the form out for you and send it to you via DocuSign to sign. So whatever's easiest for you. Chris and Andy are happy to take the call, or if it's easier for you to email your advisor, they will pass the information along to Chris and Andy and they'll get you the form.
Yeah, and I throw one other thing on trusted contacts. Denise, you may have said it, and if I'm repeating it, I'm sorry, but I think it's important. Trusted contacts can be revoked at any time. So if it's your neighbor and you get in a fight over loud noise, or it's your sister-in-law and now not your sister-in-law, you can revoke it, you can change it. It is all under your control. So remember that, life changes and your document preferences can as well, including the people that we have access to serve you. All right, I've got one more and I'm going to pass this one off, but it is a topic that has come across the halls of the Wealth Stewards quite a bit over the last month, I would say, and certainly back over the last year plus. And the question is, has the value of crypto changed with the passage of the big bill? And perhaps maybe, how should be in the question that, because the value of crypto, price of crypto changes all the time. Value is in the eye of the beholder. So let's make it a broader question with, how has the big, beautiful bill impacted crypto? And if anybody wants to take a jump in there, I think be great to hear a couple different thoughts. Brent?
Yeah, so there's nothing specifically in the big, beautiful bill about crypto, but there's a lot happening in DC, particularly the Genius Act, which was passed in July 18th, and it was the first federal stablecoin regulation. So all that says is that there's a there in terms of crypto. It's not addressed in the big, beautiful bill. There's a couple other pieces of legislation that are passed Congress. They're making their way to the Senate right now, which is gonna I say greatly normalize the view of cryptocurrencies as their own distinct asset class. To Jeff's point, this has been an ongoing conversation we've had in here for the better part of 6 months. We've learned a lot about this asset class. I think all of us are sitting here, I don't know if I can say that, but have personal experience with this asset class. So it's something that's, let's just say that we're taking it very seriously and we're looking at it very closely.
Yes, I think, I was a naysayer back 10 years ago when some of my friends were early adopters, thought a lot of, fads that have come and gone, going all the way back to tulips. And 10 years later, you look up and you say, well, again, value is in the eye of the beholder. So when Bitcoin as the primary crypto is trading somewhere near $120,000 a coin, there are a lot of people who believe there is value in this. And so that is an important thing to be aware of. One of the things we've been tracking for a long time and have conversations about is the behavior of crypto, in particular Bitcoin, has a lot of profiles to volatile stocks. And that may change. Again, the future is different than the past largely. But that's the hard thing about modeling it and how it behaves and if it belongs and where it might belong. But again, there have been lots of robust conversations internally, but then with our partners that we collaborate with on portfolio decisions and modeling at Fiducian and our friends at Concurrent, our corporate RIA that we work with. So Ryan, you got something to throw in there, buddy?
Yeah, I was just going to say, it's not really just commenting back on the question, depending on what they meant by that, if adding, a bunch more debt through this bill is somehow impacting the price in crypto in terms of Bitcoin being a replacement for the US dollar down the road, something like that. There was a spike. I would say it's impossible to say what that is specifically, causation. But that's an idea that's been floated and talked about. So if that's what they were referring to, I would say that that's not going to, at this point, that's not a long-term impact to prices in crypto markets that we're anticipating seeing play out or anything to that extent.
Well, as I suspected when the first question came out, it has led to a cascade of additional crypto questions. And
Here
so they're great questions. They're actually fantastic. They're the right questions. So the first one is, could you opt out of crypto if that's something we decide we want to implement? Absolutely. You can do that with almost any position, right? Like while we do model investing for you, you have an individual advisor who understands your individual preferences. So you can talk about those things if we decide to do that. So absolutely on that. The next one that I'll give somebody else because it's super. Oh, Brent.
I want to just add
give you the softball.
In fact, can we all just take a moment, and clients included, to recognize the fact that the reason we are independent today is we could never have even addressed this conversation at our past broker dealer. And so I think the fact that now we can have these discussions without basically having to repeat what the broker dealer says we can say, we're able to offer a much higher level of advice than we could have in the past. So just want to recognize that.
Great point. All right, the other one's this is more of a comment or it's a question, but it's certainly a great suggestion in the phrase of a question, which is, could we put together a cryptocurrency tutorial or information on the website? The answer is absolutely yes. As we alluded to earlier, there's a bunch of content that is going to be continually produced and pushed through the website once it's up and running. The best thing about having a custom-built website is we own every facet of it, including the ability to control content delivery and then message that content delivery to you all as clients. So that's a big back-end function of this, and we certainly will take that question as a suggestion and be sure before anything that we decide if it impacts you. Certainly, we do some good education around it, and for you to all understand why we might consider doing it if we end up getting there. So last one, because we want to hold ourselves here to 45 minutes. That's our commitment. And if there are any questions that you haven't asked and you want to, you obviously know you can reach out to any one of us and we'll make sure to answer it for you. So the last one, what's the current thinking about investments in precious metals as safe havens against economic fluctuations?
Yeah, Jeff, I'll start with that one. So I think we've seen, particularly now with gold and silver and many of the precious metals back near highs, that there's more of a conversation. I'm getting more calls randomly of people wanting to sell me gold and silver. So it's come back a little bit more in vogue. I think a lot of that is tied to what Ryan mentioned, is some of the concern about the stability of currency and fiat currency in the dollar, which is what's speculated to lead to cryptocurrencies rise here recently. But I would just go back to some of the changes that were made at the beginning of the year when there was a chunk taken out of US equities. Yes, some of it went into international stocks, but also in other areas like alternatives that do provide meaningful differentiated returns from the overall stock market. So gold is one that tends to not really follow the trajectory of the stock market, but there are also other investments that we've incorporated into the portfolio that, dating back to 2022, which was a rough year for a lot of different parts of the market. Bonds didn't provide that stability a year like that. In fact, they tended to move more in tandem with stocks. But some of the other alternative investments were actually up and meaningfully in a year like 2022. So not just looking at things like commodities, which gold is one of those commodities and real assets, but other alternative investments that do provide a lot more diversification and tend to zig when the market zags.
And also,
yeah, go ahead, Brent. Yep.
I could add this to answer your question directly. In our alternatives asset sleeve, inside those funds, there's indirect exposure to precious metals. So those, I would say that almost every single one of our clients and everyone that has our alternative sleeve has some indirect exposure to precious metals.
That was right where I was going to go. It's 46 after the hour, and that means that we filled all the time we wanted to a lot, and hopefully we didn't overwhelm you. One of the objectives of this is to make you feel like you have a quarterly way of checking in if you haven't heard from us or you've been busy. It's concise, it's impactful, and it shows the breadth of minds that are working on the behalf of everybody who's a Wealth Stewards client. So special thank you to all of my partners, to Andy, who's in the background, and to Kayla, who's in the background, and to Chris, who's running this, and to Andrew, who also is on the East Coast. Everybody's here in support of you all. And if there's anything you need in follow-up, we're here. And for now, we'll say goodbye. Enjoy the rest of summer, and more to come in our next town hall at the end of Q3. Thanks, everybody.